Hi everyone, this is a technical analysis on USDJPY. Let's start with some fundamental background first. In the US, the Fed left the interest rates unchanged as expected, with basically no change to the statement. Fed Chair Powell stressed once again that they are proceeding carefully, as the full effects of policy tightening have yet to be felt. The recent US core PCE came in line with expectations. The labor market is starting to show some weakness, as continuing claims yesterday showed another increase, and the NFP data last Friday missed across the board. The US consumer confidence fell for the third consecutive month, although the data beat expectations. The US ISM manufacturing PMI last week missed expectations by a big margin, followed later on Friday with a disappointing ISM services PMI, although the index remained in expansion. The market doesn't expect the Fed to hike anymore. In Japan, the BOJ kept its monetary policy unchanged, but formally widened the yield curve control to 1% on the 10-year JGBs, stating that it will be a reference cap. Governor Ueda repeated once again that they won't hesitate to take easy measures if needed, and they are not foreseeing sustainable price increases. The recent Japanese CPI showed that inflationary pressures remain high, with the core reading hovering at the cycle highs. The unemployment rate remained unchanged near cycle lows. The Japanese manufacturing PMI matched the prior reading, remaining in contraction, with the services PMI falling but holding on in expansion. The latest Japanese wage data beat expectations. As a reminder, the BOJ is focusing on wage growth to decide when to tweak its monetary policy. The market expects the BOJ to keep interest rates unchanged at the next meeting as well. Now, on the daily chart, we can see that the USD/JPY pair erased almost all the losses from last week as the US dollar benefited from a bounce in treasury yields and the hawkish Fed speak. It looks like the pair is bound to test the highs here again and maybe even make a new cycle high, but the divergence with the MACD continues to call for caution, especially since the US labor market is showing clear signs of softening. On the 4-hour chart, we can see that the pair managed to break above this resistance zone around the 150.70 level, and the buyers increased their bullish bets into the recent high as a consequence. The sellers are likely to step in around the cycle high here at 151.90 to position for a drop into the black trend line and eventually a break lower. The buyers, on the other hand, will want to see the price breaking higher to target the upper bound of the rising channel here at 153. On the 1 hour chart, we can notice that we have a divergence here with the MACD on this time frame as well, which is generally a sign of weakening momentum, often followed by pullbacks or reversals. In this case, the price is likely to pull back into this trend line, where the buyer should step in again to target new higher highs. The sellers, on the other hand, will want to see the price breaking lower to confirm a reversal and target the support at 150.70 first, and eventually the trend line around the 149.80. Today, the only market moving event will be the release of the University of Michigan Consumer Sentiment Report. Strong readings might support the USD further, while weak figures are likely to weigh on the greenback.